Hi, everyone. Marc Lichtenfeld, Chief Income Strategist with the Oxford Club. Welcome to State of the Market. First, I want to thank the more than 3,000 of you that have subscribed to this channel, including the more than 1,000 just in the past 2 weeks alone. That is amazing. So thank you very much. You know, every day I get emails asking me, where should I invest today? I have $500, $1,000, or $5,000. Where should I put that money today? The answer is very simple. Invest in biotech penny stocks that claim to have the cure for COVID.
Wrong.
No, do not do that. I'm kidding. That's equivalent to lighting your money on fire. Do not do that. The answer, it really depends on your tolerance for risk and your time horizon. It would be very easy for me to just give you 3 stocks, but what good would that do if it's going to keep you up at night, if you're not going to be able to sleep because you're so worried about it, or maybe on the other end of the spectrum, if you are looking for some action, and these are slow and steady wins the race kinds of stocks. So it really depends on your tolerance for risk and your time horizon. So for example, if you can't afford to lose any money, so you can't handle any risk, then you can't be in the market because you cannot handle a loss. And that's not a judgment. It just means if you have money that is required to pay the rent or to pay tuition or the mortgage, you can't afford to lose that money. So it should not be at risk. So unfortunately, you can't make a lot of money with that money because to make money, you have to take on a little bit of risk. Today, you can get about 1 to 1.5% tops on your money in a safe investment, meaning a CD or a money market account or a savings account. Now in a CD, you're going to have to lock up your money for a certain period of time. And if you take it out before the CD matures, you could actually pay penalties, end up losing money. So I recommend probably a money market that pays 1 to 1.5% if you can find it. And they are out there. You know, back in the old timey days when I was starting out, you could get 4% on a savings account, or heck, I even got one on a checking account, 4%. It was unbelievable, but those are different days. Today, 1.5% is tops. The benefit though, is that money is safe. It's FDIC insured and nothing will happen to your money. Now, if your time horizon is a little bit longer and you can take on a little bit of risk, then you can look at bonds, corporate bonds. Now, these are loans to companies, and just like a regular loan, you get paid interest on the loan. But here's the thing. A bond usually is in $1,000 increments, but you can buy them on the open market below or above $1,000. So let's say you buy a bond for $900 and you get paid the interest along the way, and when it matures, you get $1,000 because the bond's par value is $1,000. So if you buy it below par, not only do you get paid the interest, but you get a little bit of a gain as well. And the opposite is true, of course, if you buy the bond above $1,000. If you bought it for $1,020, you would lose $20 at maturity, but the interest would hopefully make up for whatever you've lost. Now, corporate bonds are not without risk, but they have low risk. So investment grade bonds have a default rate of just 0.1% a year. So 1 in 1,000 go bust, while bonds below investment grade have a default rate of 4%. So considerably higher, but you can shrink that number very meaningfully by buying the highest rated non-investment grade bonds. Here's an example of a few bonds that are kind of at the top of the non-investment grade sector. Kraft Heinz, whose bonds are paying 3% a year and mature in 2 years, or Ford, the car company, has a bond that matures next year with a 6% yield. So some really good companies out there where you can still make a decent amount of interest. Now, if your time horizon is a little bit longer and you can take on a little bit more risk, just not an insane amount of risk, just general market risk, then I recommend a portfolio of no-load mutual funds, particularly index funds. And Vanguard tends to be the cheapest. Now, you want to have a mix of US stocks, foreign stocks, and you probably want to sprinkle in some funds specializing in real estate and precious metals and fixed income, but the bulk of your index fund portfolio should probably be in stocks. Now, anything can happen to stocks in the short term, and we know that stocks go up over the long term, but short term, anything can happen. And we saw that just recently in February and March when the market sold off by 35%. So you have to be able to withstand that kind of short-term downturn, but long-term, like I said, stocks go up. In fact, over the last 50 years, the S&P 500 has gone up an average of 10.6% per year. Now, that doesn't mean you're going to get 10.6% every single year. Some years you're going to get 21%, other years you're going to get nothing. The next year you might lose 5%, the next year you might make 15%, and so on. But over the long term, the S&P 500 goes up 10.6% a year. Maybe that doesn't sound like a lot to you, but think about this. After 5 years, a $5,000 investment earning 10.6% a year turns into $8,274. After 10 years, you're sitting on $13,694, nearly tripling your money, and that's with a one-time investment. Obviously, if you continue to invest over time, you'll make even more money. Now, if you want to beat the market, I recommend investing in perpetual dividend raisers. Now, I talked about these in last week's video, where I gave out the name of a website that lists all of the perpetual dividend raisers, and it's absolutely free. So please check out last week's video if you're interested. Now, perpetual dividend raisers are companies that raise their dividend every single year. Now, the benefit of investing in these kinds of companies is that in addition to the stock price appreciation that you'll get over the long term, you also get dividends, and you can collect them as cash. So you can use that money to spend on whatever you want. And the amount of money that you get goes up every year, which is great. Or you can reinvest the dividends, which compounds your wealth. It helps your wealth grow even faster. So back to the original question, where should you put $5,000? Well, to recap, if you can't take any risk, find a CD or money market or savings account. The interest rate is going to be bupkis, but your money will be safe. If you can handle a little bit of risk with a time horizon of a few years, then look at corporate bonds, particularly investment grade or just below investment grade. And if you have a longer time horizon, you can take on market risk, look at a mix of no-load index funds. And lastly, if you prefer to generate more income from your stock investments, take a look at perpetual dividend raisers. Now, I write about stocks and particularly perpetual dividend raisers and bonds and all kinds of other investments in my free newsletter, Wealthy Retirement, which you can subscribe to for free just by clicking on the link below. Well, that'll do it for us on State of the Market this week. Until next week, I'm Marc Lichtenfeld. Thanks for watching.